Welcome to the Fear and Greed Daily Interview. I'm Adam Lang. We talk about investing in a range of sectors here, from miners and the banks to the energy sector, but one sector sometimes overlooked by fund managers is fashion. It comes within retail, which is a fascinating space for investors. Remember that this is general information only, and you do need to get professional advice before making your own investment decisions. Chloe Stokes is a senior analyst, international shares at Forager Funds Management. Chloe, welcome to Fear and Greed.
It's a pleasure. Thanks for having me.
Chloe, can you set the scene for me? When we're talking about fashion and beauty, what companies are we looking at?
Well, there are all different types of companies within those spaces. You have your general retailers, you have big brands that everybody's heard of, like Nike or Adidas, and you have things like luxury houses that are largely listed in Europe, like LVMH, who owns Louis Vuitton, and Kering, who owns Gucci. But it's quite a broad ranging number of companies and types of companies within that space.
So generally speaking, when you consider those companies, how exposed are they to an economic downturn or economic fluctuations? When customers have less money in their pockets, are they less likely to spend it on fashion and beauty?
Well, that depends. I mean, obviously, all retailers prefer a booming economy, but it does really depend on the particular company and the customer demographics. For example, rising interest rates will really impact the cost of housing for some retailers, which will have a negative effect on things like kind of Nick Scali, which are furniture retailers where, products are large discretionary purchases. But if you contrast that with something like Lovisa, which is a jewelry retailer listed in Australia, where most of their customers don't have a mortgage, and we've got high employment and wages increasing, and these customers might actually be a beneficiary of this kind of environment. And then you have ultra luxury customers, and this isn't necessarily fashion, but it's just an interesting tidbit, like Ferrari. And they said on a call recently that their customers just don't do recessions, which must be nice.
Yeah, that's a privilege.
Yeah, exactly. So it really depends on the demographics, but obviously a booming economy is ideal for most retailers.
You bet. So how much has the sector changed in recent years, particularly with the e-commerce boom?
Well, there has been a shift towards e-commerce, and that has been really kind of pushed forward throughout COVID. A lot of companies who hadn't spent too much time thinking about their online offering before were forced to, because their stores were shut and they had no other way to sell their products. And what we saw was a really dramatic increase in online penetration across all retailers. But interestingly, and perhaps surprisingly, definitely to us, we've almost seen in a lot of cases things just go back to trend lines, which is kind of proving the business case for bricks and mortar retailers. Consumers still like going into stores. They do like using online as well, but those bricks and mortar stores are always going to be important for shopping and consumer experience.
Yeah, sometimes we just need to see how it feels and see how it looks before we make a decision.
Exactly. And a lot of people actually enjoy the process of shopping.
Some people do.
Yeah.
Stay with me, Chloe. We'll be back in a minute. I'm speaking to Chloe Stokes, Senior Analyst in International Shares at Forager Funds Management. So when you're looking for value in these companies, what are you looking for?
I try to think about it in the same way that I think about stocks in all other industries. I want to buy stocks where I think we're going to get above average returns over long periods of time. So I focus on businesses where I have a variant perception. Essentially, the price of a stock reflects the market's future expectations for a business. So if your view of the future is the same as the wider market, then the stock is probably not mispriced. Essentially, I just want to pay the right price for any business. But within the retail sector specifically, there are a couple of different models for success. Businesses can have rapid growth from store rollout programs, which is obviously great. And then others can be a bit more disciplined in their store rollout, and they roll them out slower, but they have impressive same store sales, and they like to attach a lot of online sales to those fewer stores that they have. And you can see nice results from that model too. But There are a lot of value traps in retail as well. A business might be trading at 5 or 6 times earnings, so it looks really cheap, but retailers are generally quite low margin businesses, so it doesn't take much to change for earnings to shrink significantly. A stagnant retailer is a dead retailer, really, because wages go up every year, rents go up every year, and as I mentioned, margins are already quite low. So if you're not growing, it's often catastrophic. So I'm open to different strategies, but I definitely want to buy retail businesses when they have a decent amount of growth ahead of them. And I want to buy them when I think that growth is going to be higher than what the market is anticipating or pricing in.
So the game is in the detail, isn't it?
Absolutely. And it's individual businesses and looking at those fundamentals and kind of also trying to invest when the market is being pessimistic about that business in particular, or more pessimistic than you think they should be.
Right. And if you consider the traditional companies in this space, have some of them adjusted better than you thought they would or not as well as you thought they would?
So there were a couple of interesting ones during COVID. A business that we own called Hallenstein Glass and Holdings. It's listed in New Zealand and it owns glass and stores in Australia and New Zealand. And throughout the last 3 years, they grew their sales on average 7% per annum. And in the last financial year, that number still includes a chunk of time where stores were shut. And this is a business that was only doing 15% of sales online in 2019. So I was really impressed with its ability to pivot between online and in-store. And their online offering is still going well. And now that consumers are back in store as well, they can service customers really well across both channels, which is obviously a huge advantage.
Are you seeing any other standout performers?
Another one that I found was interesting was US listed Ulta Beauty. It was for a bit of a different reason, though. They grew their online channel significantly throughout the pandemic, but what they did was really focused on something called buy online, pick up in store, which is much higher margin than straight online sales due to cutting out delivery costs. So they focused on keeping as many sales dollars as possible while still being really focused on the bottom line. And it's the same thing. Consumers are going back in store, but the online business is very strong. And that buy online, pick up in store is a huge chunk of online, which is great for their margins.
I'm just wondering if that buy online, pick up in store also improves their returns. So, the wrong item wouldn't get delivered because it wouldn't be picked up, or the wrong size. Have you seen anything there?
I think it really depends, because during COVID there was a lot of kind of dropping off and no touching,
contactless,
and no looking. But definitely, I think in current days, I haven't seen anything stand out in the results. But returns would be a lot cheaper if you get into your car and you look at it, even if you have taken it, and you just walk back into store rather than having to deal with shipping and going to a distribution centre.
Chloe, in recent years, we've seen fast fashion and then a trend towards a greater consciousness of the environmental impact of fashion, disposal, recycling, different fabrics. Are you seeing any impact there?
It's definitely something we're thinking about, and it's top of mind for a lot of consumers, especially, I would say, younger consumers. And ESG in general is something that we think about across all businesses, and we make sure that we're pricing it in when we're valuing a business. It's really important and top of mind. Mm-hmm. The thing is, when customers are kind of demanding more from these companies and regulations are changing in terms of sustainability, these companies need to respond when the consumer demand is there, and there are definitely costs related to that.
So with all this talk of fashion, Chloe, I have to ask you, what would be your favourite fashion item?
My favourite fashion item is actually, it's kind of dropping out of season right now, but it's my trench coat.
Okay.
I love it. It's just one of these things you can wear anywhere, over anything, for any occasion. The cost per wear, incredible.
Especially in La Nina, right?
Exactly. I've been wearing it into November, which is unheard of.
Chloe, thank you very much for talking to Fear and Greed.
Thank you for having me.
That was Chloe Stokes, Senior Analyst in International Shares at Forager Funds Management. This is the Fear and Greed Daily Interview, and remember that this was only general information and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Adam Lang. Enjoy your day.